Hi.
Saurabh, hi. Great to have you on, and great that the audio and video is back up. And of course, we'll talk about some of the insights for 2025. But since we have you today, when again you're seeing the secondary markets taking a beating, it almost seems like all the action is only in the primary markets. Is this, you think, a temporary blip or some structural deep-seated fears that we're seeing in the Indian markets right now?
I won't call it structural, I'll call it cyclical, right? I think as we discussed last time I was on your channel a month or so ago, we had 3 great years after COVID. Economy did really well. We had 7%, 8% GDP growth, almost 20% earnings growth 3 years in a row. And usually in India, if you have 3 terrific years from an economy perspective, you then get a cyclical downturn. I think we've entered a cyclical downturn. The first half of FY25, the first half of FY25, the government announced tax collections, corporate tax collections for the 9 months to 17th December, I think, were announced. And you can see from the corporate tax collections, they're only growing at 8.5%. So that suggests a clear cyclical downturn. There's nothing fearful about it. This is par for the course. We are a free market economy. We go through cyclical ups and downs. The only thing is we're entering the cyclical downturn with elevated valuations in the stock market. And therefore, I think the correction that we have seen, I think markets are off, say, 10% or so at the Nifty level. The correction that we have seen, I think it has more to run. We just need to sort of correct the valuations to align with the fact that we are entering what looks like a multi-quarter cyclical downturn.
Okay, so Saurabh, good morning. Two interesting things that you've spoken, which might spook a bullish mind. One is, or a bullish nature person, that one, multi-quarter, and two, that there is some more correction to run. So, is there a typical cycle length that might happen as per your analysis, or some thoughts around how long can this downturn be, and what's the quantum of correction needed to discount 1 year forward multiples?
So look, I mean, if you leave aside crises such as, say, Lehman Brothers, if you leave aside such crises, Neeraj, normal cyclical downturn, peak to trough correction of 25% takes care of most excesses. And remember, the Nifty itself, it's not as if the Nifty had some wild ride from over the last 3-4 years, right? If you leave aside the COVID trough, the Nifty has sort of done around mid to high teens. So the Nifty is not massively overvalued. I think another 10-15% on the Nifty, we should be in reasonably safe valuation territory. Where I would be more concerned is I think there are clearly pockets of froth in small and mid cap. Those built up as the retail investor count in India quadrupled over the last 4 years. Pockets of froth have built up in small and mid cap. That has been evident over the last couple of years. I think those probably will be the greater spots of concern, right? So, for example, the whole ecosystem of contractors who supply to the defense ecosystem, to the railways ecosystem, the road builders who build roads for the NHAI. The whole contractor ecosystem, I think, got wildly overvalued. Similarly, plays in building materials as elements. The building materials ecosystem also got very excited by the post-COVID turn. The economy is normalizing after the COVID revenge spending bout. As the economy normalizes, I think specific spots of overvaluation in mid cap are bound to get squeezed out. At the Nifty level, I think another 10% will be in sensible valuation territory.
So, what is this journey to sensible valuation territory going to look like, Saurabh? I think that's the key question. Is it going to be painful? Is it going to be paved with value destruction? Or are there going to be opportunities also along the way? I mean, right now, the big question for everyone is what is the next big opportunity and where is it coming from?
So there will clearly be opportunities. The export piece, I think, is coming alive very nicely over the last 12 months. In our small and mid cap portfolios, we're seeing the export-oriented companies sparkling over the last 3-4 quarters. After a really difficult 22-23, India's exports are picking up nicely. The rupee coming off is clearly going to help exporters. I think there's more downside on the rupee that will further help exporters. On IT services, you saw Accenture raise their guidance. It's also clear that on the employment front, Indian IT companies are hiring hiring more people. So the IT companies have long indicated that they were waiting for the post-COVID upturn that seems to have begun for the IT services companies. On the pharmaceutical side, Indian pharma companies having a great run in our portfolio. Divi's Lab continues to grow from strength to strength. If Trump comes and imposes 60% import duties on Chinese API manufacturers, that'll obviously be a shot in the arm for Indian exporters of API to the Western world. So there's plenty to look forward to on the export side. Even on the domestic ecosystem, if you leave aside the urban consumption downturn, which has been commented upon by several CEOs, the rural piece in India is holding up quite well. So right now I'm with my colleagues in rural Tamil Nadu, and we're seeing a reasonably robust demand picture in rural India. I'm in Tamil Nadu this week. 2 weeks ago, we were in Telangana. Similarly, upbeat picture in Telangana on the rural side. So the economy overall is in decent shape, but at the chart that you're flagging up, the FMCG and PV volume suggests there's an urban consumption downturn. I think that will persist. If government capex picks up after a 6-9 month lull, if government capex picks up, that'll also help the economy. But if Nifty currently for a forward P on Nifty would be 21, 22 forward P. I would say somewhere around 18 times forward P for the Nifty would be a sensible place to consider long-term investing in India. And in parallel, as I've said over the last couple of years, I think most Indian families should consider building a significant corpus of investments focused on the North American market. All our technology in this country, all our software, much of our hardware comes from North America, and building a portfolio which has, say, 2/3 India, 1/3 North America, I think is not just good from a diversification perspective, it also gives you exposure to the world's best tech companies.
No, so how do you do that? And you mentioned briefly Accenture and its impact. We saw IT stocks moving up and then petering out quite quickly. What's not clear is that whether this is a real pivot or change for Accenture. Yes, their numbers have come in better than expected, but they're still not completely bullish or out of the woods on the demand situation. How are you seeing Indian IT stocks? How does family build their portfolio, like you said, focused on North America and tech?
So let's quickly address Indian IT, then I'll come to the North American piece. Our discussions with the Indian IT services companies and the ones that we have in our portfolio. So, for example, we have HCL Tech in our portfolio. It suggests a reasonably clear demand picture. Remember, the Indian IT services companies had said for the last couple of years that their order books are bulging, record order books, but execution in terms of the client pressing the green signal on go ahead, get the work done. That was where the issue was. That seems to be abating materially, and hence the uptick in recruitment, right? Even in Naukri.com's data, you can see that IT services recruitment has clearly picked up. So I'm Accenture naturally is being a little circumspect, given that they don't want to let the stock price run too far of itself, I suspect. By the way, disclosure, I also own some Accenture stock. I used to work there 20 years ago, and they gave me some shares, which I still have. But on the Indian IT piece, my reading is that the outlook is clearer than it has been in the last couple of years or so, and given that the new president, America will get its new president taking charge in the next month or so, I think we should expect to see further bullishness from corporate America in terms of tech spending, which will help Indian IT. Coming to how does an Indian family build a North American portfolio. 2 years ago, we launched what's called the Global Compounders portfolio. It's compounded at a handsome rate. We are underweight on the what's called the FANG stocks or the Magnificent Seven stocks. We are underweight on that. We're overweight on American mid-cap companies. So mid-cap in America is around $20 billion of market cap. We also have Canadian mid-caps and a few German and French mid-caps. These companies are trading at around 17, 18 times forward. Ironically, the fair value of the Nifty, which I think would be fair value, is what American and European mid-caps are trading at. They're growing earnings also at 17, 18% dollar terms. So you're basically getting them at what's called 1 times PEG. The PE multiple divided by the earnings growth is 1 times. In India, as I'm sure everybody watching realizes, it's very difficult to get companies with say 20% ROC, 20% EPS growth, 20 times earnings. So from a valuation perspective, I think it makes a great deal of sense to go west, look for small and mid caps trading in the Western world at good valuations. These are globally market leading companies. So for example, there's a company called Heiko in our portfolio. It makes 80% of the world's seat belts. So when you get on a plane, the seat belts are almost always from Heiko. Similarly, we have a company called ASML in our portfolio, which makes the lithography for all the electronics that you and I are using for this broadcast. And that aspect of large developed markets, that you get high-tech companies with very sensible valuation multiples, and thus allowing you to compound at high teens to early 20s. It compounds at high teens and early 20s, and you're getting diversification vis-a-vis India. If the rupee comes off as it's been coming off over the last 6 months, if the rupee continues coming off, you get a further fillip from that. And all credit to the Gift City regulator. The Gift City regulator has made it very, very easy for Indian families to now invest into America using this portfolio management construct.
In fact, Arindam Mandal, your colleague, is also with us. He's head of global equities at Marcellus, also joins in. Arindam, how difficult or easy it is, one, from an Indian investor to do this? And Saurabh explained that now it's become much simpler. But two, also the uncertainty, right? I mean, for example, if we talk about ASML that Saurabh spoke about, I mean, in November 2021, it was at circa $700. It's circa $700 right now. So it's a very difficult set of instruments to track, right, for somebody seated in India.
They are. You're right. I mean, these are cyclical companies, so you have to understand the cyclical nature of every company to some extent, and also the process that you have set up over the last 2-3 years is actually quite robust. In fact, I mean, if we are, like, say, having this discussion 10 years back, it would have been very, very difficult. But right now, I mean, we have access to people, we have access to information. Actually, I mean, in terms of getting information or getting access to people, the relevant people, I would say it is almost at par being in London or in New York. In fact, I mean, I was in New York for a long time. And when I see the quality of research or quality of things that you can do staying here, I can see, I mean, there is not much of difference per se.
Okay. Okay. Saurabh, would that be the tilt until the cycle again changes in India? Because I heard you say, right, that there's this, we are entering this cycle, hopefully it turns, but until it turns, is it a balanced mix of global and local? And would that change if the Indian cycle turns? Because typically India, I mean, growth can be very, very rapid if it turns, right?
No, lovely point, Neeraj, actually. So this is exactly the reason why I think Indian households should have a mix of North American and Indian equities. America and India are the two stock markets which are least correlated with each other. They are the world's two highest performing markets. Over 20 years, we are ahead of America. Over 10 years, America ahead of us. Last 10 years, the American market has given 2 percentage point per annum better return than us. But typically, we are the two best markets in the world. But the great news for everybody watching is India and America, the markets have very little correlation with each other. And the result is, if you combine your equity portfolio, some India, some America, you get diversification. That allows the investor to do exactly what you're suggesting, Neeraj. When India is superheated, shift money to America. When America is superheated, shift money to India. Diversify across both markets. When you see greed in India, take money off the table, invest in America. When you see greed in the American market, excess and froth in the American market, allocate to India. So my reading is, given where we are in the Indian stock market, given the fact that I think the valuation correction that's begun has room to run, given the pressure on the rupee, and given that the American economy is in good shape and American mid caps are very, very reasonably valued, it makes eminent sense to diversify from a valuation perspective, from a currency diversification perspective, and from loading up on high quality American companies available at great vals. Similarly, a year, maybe 2 years hence, we might have to toggle back. 2 years hence, we might have to toggle back, saying reduce exposure to the United States and come back heavily to India. But at this juncture, where we are in the Indian valuation cycle, where we are in the economic cycle, I do think it makes a lot of sense to increase exposure to the North American market.
All right, thank you so much for that, Arindam. Saurabh, great to chat with you, and we hope to get you back here on the show in the new year with a lot to look forward to in 2025.